In the meantime, folks, my next guest, well, he actually remains optimistic about the market, and he's aggressively staying in this market. I want to bring in Kingsview Wealth Management CIO Scott Martin. Scott, listen, I know you've been really active. I know you took some profits on names that you shared on this show, Tesla, I think, and is one of them. And you're plowing the money into banks right now. So you must think the crisis is over or at least contained.
Contained, possibly, Charles, and overdone, yes. Plowing, shoveling, hauling money into the banks, Charles. I mean, we talked a couple weeks back, my friend, I believe it was 3/17. I think we were celebrating St. Patrick's Day together, actually, with buying banks back then, man. And that's worked out great. I mean, you look at the Commericas, the Fifth Thirds, the JP Morgans, the Goldmans, Truist. Those have been just absolutely destroyed. And so the common equity of those are places we put some extra cash, like you mentioned, from selling things like Tesla and Facebook this year. Google, we trimmed recently. But also, Charles, now looking at the banks, not only at the common equity side, but some of their preferred stocks as well, which are yielding crazy par values and also amazing yields as well going forward.
All right, so I got the banks up here. You've mentioned them already. Regional side, Fifth Third, Comerica, the money center banks, Goldman Sachs and JP Morgan. Let me ask you, Scott. Is this a balancing thing? In other words, I would imagine the regionals are just sort of higher risk right now. Are you offsetting that with the money center banks? For a little bit more, a little less insurance, maybe insurance, for lack of a better word?
Exactly. Kind of like having a backup date in case that one girl cancels on you. Because here's the thing. I think you can own them across the board. But you're right. If your risk profile for some of our clients is a little bit, say, more conservative, then you want to trend more towards the money center banks. But just remember, you're not going to get that upside when the banking sector recovers like you will in the regionals. Because, again, I think the outcry, or let's say the downtroddenness in the regionals is just way overdone, whether it's commercial real estate loans that they have on the books or just the fact that everybody still is freaking out somewhat on the depositors fleeing those banks, because those banks are well capitalized. Their duration outlook is fine with respect to their balance sheet. So they have a lot of things going for them that they're not getting credit for. So you mix and match those things. But I believe on both sides of those things, whether it's regionals or money center banks, you're going to get a nice turnout on buying the equity there.
Scott, recently, I think it was Monday, City Research posted this great table, and it had maybe like 9 categories. In every single category, Domino's was better than Pizza Hut. I'm talking brand, taste, quality, delivery time, service, price, menu, everything. And I think about that because people always urge to, buy what you know, buy what you like. But in this case, if you bought Domino's, and by the way, Pizza Hut is owned by Yum, so I would compare Domino's to Yum. You'd be down 19% if you bought the Domino's, even though it beat them on everything, and that's over the past year. You'd be barely break even over the last 3 years. Conversely, if you bought Yum in the last year, you'd be up 6%. Over the last 3 years, up 103%. So the reason I bring this up, in part because I also know that Yum is the parent company of Taco Bell. Isn't there a moral to this story? Like, you just can't always go out and because you might, like something. You got to do more work. It's a good starting point, but there's a moral to this story, right?
A moral to the story, man. And when you're talking about Taco Bell, those are the morals. I mean, eat at Taco Bell. I mean, that's a morality thing. You must do that for your life. It is, though. I think you make a good point. It's always good to buy what you know, buy what you like, but also do a little bit more research than that. I mean, a perfect example, Charles, today, Lululemon versus, say, an Under Armour or some of these other companies that are out there. It talks about how some of these companies, whether it is a Pizza Hut or Yum Brands in the case of what you mentioned, or a Domino's, Papa John's, like if you just look at how these stocks are treated in the marketplace, how they're traded over the course of time vis-a-vis the space itself, you can find a lot of value there, and you may be buying a pizza chain that you don't necessarily like, but your portfolio will like it because it's undervalued.
Yeah, I got to be honest. I buy stocks in a lot of companies I'm not too hot on or don't know about, but I'm not hip like that anyway. Scott, thank you so much, my man. Appreciate it.
See ya.
All right, folks, my next guest says that